The biggest risk to the United States economy was never just the AI bubble. It was never only China. And it was never just whoever happened to be sitting in the White House. Instead, the real risk might be something far more boring, something most people have never heard about. And that's exactly why almost nobody is paying attention to it. Because if you've ever wondered why mortgage rates refuse to fall, why stock markets suddenly panic every few months, or why the Federal Reserve talks about cutting rates but money still feels expensive, the answer might not start in Washington. It starts in Tokyo. And more specifically, it starts with one of the most boring assets on Earth: Japanese government bonds. Now, I know that doesn't sound exciting, but the country famous for anime, technology, and attracting American tourists has quietly been helping hold together the global financial system for more than 30 years. And that support system is starting to weaken. To understand why, we need to go back to the early 1990s, because in 1992, Japan's massive asset bubble burst. Real estate crashed, stocks crashed, and Japan entered what became known as the Lost Decades. For nearly 30 years, economic growth remained weak. Inflation was almost non-existent. Wages barely moved. It was like the entire economy got stuck in slow motion. So the Bank of Japan did what central banks usually do when growth disappears. They cut interest rates, then they cut them even further. Eventually, rates fell close to zero. And when that still wasn't enough, Japan introduced something called yield curve control. That sounds complicated, but the idea was simple. The Bank of Japan wanted long-term interest rates to stay low, so it actively kept bond yields from rising too much. In other words, Japan basically glued interest rates to the floor. For years, Japanese government bonds paid almost nothing. And that created a problem. Imagine you're a Japanese pension fund, insurance company, or bank. You manage billions of dollars, but your safest investments pay close to 0%. What do? You have two choices: accept almost no return, or invest somewhere else. Japan chose the second option, and that's when a huge amount of Japanese money started flowing overseas. Over time, Japan became one of the largest foreign holders of U.S. Treasury bonds, one of the largest buyers of U.S. mortgage-backed securities, and eventually the world's largest creditor nation. In simple terms, Japan became one of the biggest suppliers of capital to the rest of the world. Not because Japan loved America, but because the math worked. Let's simplify it. Meet Bob. Bob borrows money in Japan at almost 0% interest. He converts that money into US dollars, then he buys US Treasury bonds paying around 4%. After costs and currency hedging, Bob keeps the difference, and that's called the yen carry trade. Borrow cheap money in Japan. Invest it somewhere that pays more. Keep the spread. Simple. And when borrowing costs are nearly zero, investors don't stop at treasury bonds. They buy stocks, they buy real estate, they buy corporate bonds, they buy emerging markets. Basically, if an asset offered a higher return than Japan, money flowed toward it. For years, this became one of the biggest sources of global liquidity. Some estimates put the carry trade in the trillions of dollars. It was like global markets were running on Japanese fuel. But there was one important assumption behind the entire system. Japanese interest rates had to stay near zero. Forever. And in 2024, that assumption started breaking. The Bank of Japan ended its yield curve control policy. Then it raised interest rates for the first time in 17 years. And later, rates moved higher again. Markets immediately noticed. After one of those rate decisions, the S&P 500 dropped sharply. Japan's Nikkei 225 experienced one of its worst single-day declines in decades. Investors were nervous because when Japanese yields rise, two things happen. First, borrowing in yen becomes more expensive. Second, hedging currency risk becomes more expensive. Suddenly, the easy money trade isn't so easy anymore. That attractive treasury investment Bob was looking at starts looking less attractive. And when the math changes, money starts moving. Instead of flowing out of Japan, capital starts flowing back into Japan. This process is called repatriation, and it could become one of the most important financial stories of this decade. Because investors are realizing something uncomfortable. The cheapest source of global liquidity over the last 30 years is no longer as cheap as it used to be. Now here's why this matters. Japan wasn't just another buyer of US debt. It was one of the most reliable buyers. And that matters because long-term Treasury yields are heavily influenced by supply and demand. Many people think the Federal Reserve controls all interest rates. Not exactly. The Fed mainly controls short-term rates, but long-term rates like the 10-year or 30-year Treasury yield depend much more on who is buying and who is selling. And that's where things get interesting, because the United States continues to run enormous budget deficits every year. That means the government has to issue huge amounts of new debt. Someone has to buy that debt. For decades, Japan helped absorb a large portion of it. But what happens if Japan slows down? Simple. Yields may need to rise to attract new buyers, and that's where this story spreads far beyond the bond market. Because long-term yields influence almost everything. Stock valuations, mortgage rates, corporate borrowing, even business investments. Let's start with stocks. When investors value companies, they use future cash flows. Those future cash flows are discounted using interest rates. If long-term Treasury yields rise, future profits become worth less today. That means stock valuations can fall even if company earnings remain strong. This is why markets can struggle even when economic headlines look fine. Now let's talk about housing. Mortgage rates are closely linked to long-term Treasury yields. So even if the Federal Reserve cuts short-term rates, mortgage rates may stay elevated if long-term yields remain high. That's why many people expecting a quick return to ultra-low mortgage rates could be disappointed. Higher mortgage rates mean lower affordability, fewer home sales, less refinancing, and slower housing activity overall. But the impact doesn't stop there. Think about companies. Back in 2020 and 2021, money was extremely cheap. Businesses borrowed aggressively. Debt financing was easy. Valuations expanded. Deals exploded. But when borrowing costs remain high, the opposite happens. Companies become more cautious. Investments slow down. Risk-taking decreases. Growth becomes harder because credit is the bloodstream of the economy. And when credit becomes expensive, the entire system feels it. And that's really the main point of this video. For more than 30 years, the United States benefited from being on the receiving end of one of the largest carry trades in financial history. Now that trade is slowly unwinding, and while everyone focuses on AI, inflation, elections, or the latest tech stock headlines, a much bigger structural shift may be happening in the background. A shift that affects the foundation of global finance itself. The reason you don't hear much about this is simple. It's not flashy, it's not emotional, and it doesn't generate viral headlines. Nobody wants to click on a video called "Japanese Institutions Reallocate Capital Through Cross-Currency Carry Trade Dynamics." People want drama. People want breaking news. People want whatever happened with Nvidia this week. But financial markets don't always move because of the loudest stories. Sometimes the biggest risks are the quietest ones, and that's what makes this situation so important. Because liquidity is the oxygen of financial markets, and if liquidity tightens, everything changes. Stock valuations, mortgage rates, corporate credit, business investment, all of it. That's why understanding these hidden forces matters. Because the biggest market risks are rarely the ones everyone is talking about. Those are usually already priced in. The risks that matter most are often hiding in plain sight. And right now, one of those risks might be sitting thousands of miles away in Japan.